Interest rates can reshape the fortunes of a bank in a single quarter. In early 2026, two Philippine banks took very different journeys through the rate cycle. Union Bank of the Philippines, powered by Aboitiz, saw its net income soar, up 167% to 3.83 billion pesos. Resol Commercial Banking Corporation, steered by Yuchenko, grew more modestly, up 11.6% to 2.7 billion pesos. But beneath these headline profits, rising rates revealed a deeper divide. Both banks benefited from the environment. RCBC's net interest income surged 25%, driven by stronger yields and sharply lower interest expenses. Its margin improved, signaling healthier lending. UBP, meanwhile, enjoyed a 6.7% net interest margin and lower funding costs, pushing net interest income to nearly 17 billion pesos. Credit loss provisions fell, giving UBP an even cleaner translation from revenue to profit. Yet, the same market forces that boosted income also tested balance sheets. RCBC's bond portfolio, marked at nearly 140 billion pesos, left it exposed to mark-to-market losses. A 2.54 billion pesos hit on other comprehensive income diluted its quarter's strength, causing capital ratios to slip. RCBC's bond book was equivalent to 94% of capital, magnifying the effect of rate movements on its equity. UBP faced bond market pressure too, but its FOSI assets were much smaller, just 21% of its capital. The resulting losses were easier to absorb, and its capital ratios remained robust. This structural difference made UBP a cleaner beneficiary of the rate cycle: wider spreads, lower credit costs, and contained bond losses. But the story didn't end there. RCBC showed leaner operating efficiency, with a better cost-to-income ratio and expanding loan and deposit base. However, higher impairment provisions offset much of its gains, and bond losses weighed heavily on its capital. UBP's resource base grew, and even as deposit composition shifted, its earnings conversion remained resilient. The lesson for investors? Headline numbers reveal little until you look beneath. UBP's nimble bond book meant rising rates broadened its spreads and left only manageable scars. RCBC's larger bond portfolio, while providing scale, rendered its capital sensitive to market swings. Both banks rode the repricing wave, but only UBP enjoyed the cleaner trade. In a rate-driven cycle, it's not just about who grows. It's about how balance sheet risk shapes the quality of that growth.